Guys, in this video we are going to discuss about how to do the capital appraisal questions. I took the HNDA 2019 past paper strategic management accounting 4th year second semester. There's a question number 5 and section 2. The question is, XYZ company considering investing in a machine to produce an item. The price of the machine will be 800,000 and its useful life is 5 years. The machine will be fully depreciated by the straight line method. The machine will be produce 10,000 items each year. The price of each item will be rupees 80 in the first year and will increase by 10% per year. The production cost per item will be rupees 40 in the first year and will increase by 15% per year. The project will have an annual fixed cost of rupees 100,000 and require an immediate investment of rupees 50,000 in net working capital. The corporation tax rate for the company is 30% and the required rate of return is 12%. As a management accountant of this company, you are required to calculate total cash flow from assets for each year. Second one, calculate net present value. Third one, give you recommendations with reason regarding the project. Okay, let's calculate the first cash flow. To calculate the cash flow, we need to find out the selling price and variable cost, because selling price and variable cost will increase over the 5 years in particular percentage. So let's calculate first selling price. Year 1, year 2, year 3, year 4 and year 5. The price per unit $80 and it will be increased by 10%. So for the first year, 80 into 1.1 is 88, and for third year, 88 into 1.1 is 96.8, and fourth year 96.8 into 1.1 is 106.48, and last year 106.48 into 1.1, it's 117.13. Okay, the selling unit the production unit as per the question paper, 10,000 unit each year. 10,000 unit each year. So selling unit is 10,000. So total sales for first year 800,000, for second year 880,000, for third year 968,000, for fourth year, in fifth year 11,71,300. Then let's calculate the variable cost for year 1, year 2, year 3, year 4 and 5. For the first year, the cost 40, cost per unit 40, and it will be increased by 15%. So 40 into 1.15 is 46, and for the third year 46 into 1.15 is 52.9, and fourth year 52.9 into 1.15 is 60.84, and last year 60.84 into 1.15, 69.96. Right. So total variable cost, the selling unit 10,000 unit, so total variable cost for the first year 400,000, for second year 460,000, for third year 529,000, for fourth year 608,400, and last year 699,600. So it's a variable cost. And then fixed cost, in the question paper the fixed cost is 100,000. So we can summarize: first, sales, first year, second year, third year, fourth year, fifth year. For first year 800,000, for second year 880,000, and third year 968,000, and fourth year 1064,800, and last year 1171,300. Right. Then variable cost, first year 400, and second year 460, and third year 529,000, and fourth year 608,400, and last year 699,600. And fixed cost 100,000. Then we can calculate the cash flow. 800,000 minus 400 minus 100,000 is 300,000, and 880,000 minus 460,000 minus 100,000 is 320,000. For third year 968,000 minus 529,000 minus 100,000 339,000. For fourth year, 10,64800 minus 608,400 minus 100,000 is 356,400. Then last one, 11,71300 minus 699,600 minus 100,000. 371,700 is a cash flow. Then we need to calculate the corporation tax. So to calculate the corporation tax, we need to deduct the depreciation from cash flow, because the full cost doesn't include the depreciations, and there are no any indication regarding the capital claim, so we can take the depreciation as a capital claim. So depreciation, the total assets value is 800,000 as per the question paper, 800,000, and depreciation method straight line method. So 800,000 divided by 5 years. So 160,000 is depreciation. 160,000 depreciation. So taxable profit 300,000 minus 160,000 is 140,000 is taxable profit. And for the second one, 320,000 minus 160,000 is 160. For third year, 339,000 minus 160,000 is 179,000. In fourth year, 356,400 minus 160,000, 196,400. And last year, 371,700 minus 160,000, 211,700. So this is a taxable amount. So tax is 30%. So 140,000 into 0.3 is 42,000. Then 160,000 into 0.3 is 48,000. And 179,000 into 0.3, 53,700. And 196,400 into 0.3 is 58,920. And 211,700 into 0.3 is 63,510. Right. So this is a tax for the particular year. So then we can calculate the cash flow for every year. Well, net cash flow. Total net cash flow. 300,000 is the cash flow before the tax. 300,000 is the cash flow before the tax, and after the tax we need to deduct 42,000 from 300,000. So 300,000 minus 42,000. 42,000 is the tax. 258,000 is total net cash flow for first year. For second year, 320,000 minus 48,000. It's 272,000. And for third year, 339,000 minus 53,700, 285,300. 285,300. And fourth year, 356,400 minus 58,920 is, and last year 371,700 minus 63,510. 3,800 and 190. This is the total net cash flow. We can give the answer for question 1. The total cash flow from the assets for each year. The second questions, we need to calculate the net present value, NPV. So let's calculate for the year. Start from 0, 1, 2, 3, 4, 5. And cash flow for the first year, there are cash flow 800,000 for machineries, so it should be cash outflow. And second one, 50,000 for working capital, it's also cash outflow. And working capital, it should be cash in the end of the project year. So it should be cash in fifth year. So fifth year, 50,000 is cash money in. For the year 1, the net cash flow 258,000. We already calculate. For year 2, 272,000, and year 3, 285,300, and year 4, 297,480, and year 5, 308,190. So altogether total cash flow 850,000 cash outflow, and for the first year 258,000, 272,000, 285,300, 297,480, and 358,190. Rate of return as per the question paper is 12%. Calculate 12% rate of return, cost of capital. For year 0, it should be 1. And for the year 1, we can get from the present value table in 12%. For year 1, 0.893. For year 1, 0.893. For year 2, 0.797. 0.797. For year 3, 0.712. 0.712. And year 4, 0.636. 0.636. And year 5, 0.567. 0.567. So the present value will be calculated, multiply the total cash flow by cost of capital. So present value 850,000 minus, and then for the first year 258,000 into 0.893 is 230,394. 230,394. So this is the present value. For the 0 year, the present value is minus. Rest of the year, the present value is plus. So present value we can calculate by at all the plus value and minus naked value. At the all plus value, every plus value need to sum. So 230,394 plus 216 1042,602.61 minus the 0 here is negative value, present value 850,000. So the NPV value is plus 192,602. 192,602.61. This is a NPV value. This is the NPV value. So NPV can be plus or negative. In this scenario, it's a plus value. So that's mean the net cash flow is plus. We can consider as the cash inflow is more than cash outflow. So this is the answer for second question. Calculate the net present value. And third questions, give your recommendations with reasons regarding the project. In this project, the NPV is plus. NPV is plus. So that's mean the project cash inflow is more than cash outflow. So we can consider to purchasing this machine for the particular company to improve the product because NPV value is plus. So that is the recommendations. As a management accountant, we can consider this project because NPV is plus. So hope this video will understand or clear your doubt on capital appraisals. If you have any doubt, please write a comment. I will rectify as soon as possible or I will reply as soon as possible. Thank you.